There's a piece of your retirement strategy that, if done right, can potentially earn an extra 0.5% each year. Surprisingly, it's not related to picking the right investments or investment alpha, which is harder to find than it used to be. It's related to tax alpha, alpha that is easy to find, but few advisors focus on it. One of the most important parts of a good retirement plan is implementing a tax-efficient withdrawal strategy. With a little planning, you can really improve your results of your plan by simply not paying more tax than you have to. And one thing we do have to understand is how different accounts affect your taxable income. So that's what I'm going to share with you in this video. If I haven't met you yet, I'm Tim, and I run Streamline Financial with Dave, Luke, and Sean, and we've created lots of tax-efficient withdrawal plans for our clients. If you're thinking about your retirement more now, but your advisor is mainly focused on investments, we hear that a lot, and you're starting to realize there's more important parts to your financial life, like tax planning, income planning, withdrawal strategies. If that's you, reach out to us for a free planning session below. So let's get into it. The first one is really just the money that comes from a single event, but we're sure happy it's not taxed. And it's the capital gains from the proceeds of a house sale. Try to think about when you're retired. Are you going to live in the same house you're in now? Maybe you're there now because of a job, because of your kids, but with a new season of life, your location may change. And we see this. Once our clients retire, we see a lot of people move, sometimes somewhere warmer, sometimes near their kids and their grandkids, sometimes away from their kids and their grandkids. I did hear this week, I'm not going to be a full-time babysitter for my kids and grandkids. I love them. I want to spend time with them. Making sure you're planning for how the house sale impacts your retirement plan can have a big effect. So let's take a look. If you move and sell your primary residence where you've lived in the house for the last 2 out of the last 5 years, then the capital gain should not be taxable if it's under $500,000 if you're married filing jointly, or if the gain is under $250,000 for a single filer. So those are the two numbers that you want to keep in mind. So if you bought the house for, let's say, $500,000 and it appreciates up to $900,000, now you have a positive gain of $400,000. If you're married filing jointly, that gain is not taxable, which is really nice. All right, the second example that we have, it's usually the pretty obvious one. It's the Roth IRA. It's the most common non-taxable account. But don't worry if you don't have as much as you wished in your Roth IRA. I'll share how some retirees are funding this more after they retire. But first is a quick recap. If you have a Roth IRA and you make qualified Roth distributions, then the money you withdraw is considered non-taxable. For it to be a qualified withdrawal, you have to take the money out after your 59.5 birthday, not just in that year where you turn 59.5. And you have to have held the Roth IRA for 5 years or more. Also, be careful not to make this mistake. If you have Roth conversions, there is a new 5-year hold rule for every Roth conversion to make sure that that is a qualified distribution. Now, the IRS does order the withdrawals for you like this. First, they start with contributions. That's the first thing that you take out of your Roth IRA. Secondly, it's the conversions. And lastly, then it's the earnings. So this is something that you may want to keep track of if you start to use your Roth IRA soon, especially kind of near that 5-year rule. Here's how some retirees are getting more into their Roth after they retire. If they work with us, they can look to see how much they can save in taxes over the lifetime of the plan, not just this year or next year. And the benefit to converting their IRA to Roth can make a lot of sense, especially if they stopped receiving a wage from work and before they start Social Security. This could be the optimal time to convert. We've made another video about this, and we'll link that below. And as I'm thinking about this, there's another non-taxable money account related to this. I'll call this the bonus method. Sort of that sweet spot age I just mentioned also could work for your non-retirement accounts, where you wouldn't have to pay tax on gains. Here's what I mean. If you have a non-retirement account, that's an investment account. An individual, a joint, a TOD, trust, those are some of the names around the taxable non-retirement accounts. And you have investments with big gains. If you have a few years of low income, right after you stop working, before you start IRA distributions or Social Security, you may be able to sell those big gainers and pay 0% tax on the gain. That's because there's currently a long-term capital gains tax rate that currently says if you're married and your taxable income is under about $80,000, or if you file singly and it's around singly, I just made that up, and it's around 40,000, your long-term gains that you recognized in that bracket are taxed at 0%, which is really amazing. But hey, be sure to talk with a wealth advisor or a CPA before doing anything big here. Realizing capital gains does increase your taxable income. So while taking them at 0% sounds fun, it's not something to just go and do. Something that we do for our clients is we put a capital gains budget for their taxable investment account that we stick to after we run their long-term tax plan. So when we're making changes or portfolio adjustments throughout the year, we make sure not to go over that budget. And if you're thinking about retirement and you'd like to talk to one of the advisors on our team, you can find a link below to schedule a time to get your free retirement strategy session. If you're a few years out from retirement, check out our video on the taxable investment account. It's one of my favorites, and it's probably not too late to start building that bucket or adding to that bucket while you're still earning good income. So the last type of money that's not taxed in retirement is one that not many people think about. It's your HSA. If you have money in your HSA and you're under 65, you can still use that money for medical expenses and not pay tax on the distributions. The really nice thing about the HSA is that you got to deduct the amount you contributed, it grew tax deferred, and if you spend it on qualified medical expenses, it's not taxed. Now, some people worry that any money left in the HSA at age 65 is either wasted or taxable, but that's not true. You should be able to roll that HSA money into your IRA and not pay tax on that rollover, which is a really nice benefit. If you like these kinds of videos on improving your retirement, be sure to subscribe so you don't miss the next video. Also, don't forget to check out the links below for our videos on the retirement sweet spot for Roth conversions and capital gains harvesting, the taxable investment account too. Both of these strategies are adding a lot of value for our retirees. So let's recap. We discussed 4 different types of money which is not taxable in retirement. 1, capital gains on house proceeds on a personal residence. Number 2, Roth IRAs and qualified Roth distributions. Number 3, 0% tax on long-term capital gains for the right tax bracket. And number 4, HSA on qualified medical expenses. If you have any questions, please reach out or I'll see you in the next video.